Yeah, hi everybody. Welcome to our mortgage or CMAP bootcamp. Hope you're all well. Hope you're well and enjoying this lovely rainy weather we've got here in the UK. Although apparently it's a high pressure system coming over tomorrow. So from now on, we're going to have like really good weather, which would be lovely to see, won't it? So mortgage updates for you. Got some cracking good sessions today on income tax. Those of you that are doing your exams or you just want to keep yourself up to date with what's going on with the technology side of things on income tax and things like that. I got some great information for you. So that's coming up in a second or two. So what's happened in the mortgage world really in the last couple of weeks? Well, not a lot, but I always say that, don't I? A couple of things actually have attracted my attention for you. The first one is the 95% lending, which lenders are all bringing out now, ready for the boom period. It might be late summer, it might be in the autumn, the first time buyer boom. The stamp duty is coming to an end, and that, of course, I should say the stamp duty embargo is coming to an end, and that will bring in the first time buyers again because they're kind of waiting. They're not rushing into buying because it's all a bit hectic and silly out there at the moment. So they're taking their time. The schemes are coming in. The 95% mortgages are coming in. I love them to bits because some lenders are adhering to the government guarantees, some aren't. But there's two issues coming through, which kind of like yin and yang, really. One is that there's reports that the affordability criteria is really staunchly difficult to get through. There's talk of massive credit numbers required. Credit searches are falling down the line. First-time buyers are having their affordability assessment rigidly assessed, more than normal. They're blaming it on the government, saying that they wanted to have affordability assessment really quite strict. I don't know if that's the case. I think they're just wanting squeaky clean first-time buyers. But on the other hand, some of them are offering like £500 cashbacks now for people to have these mortgages. So, one hand they're offering them a bung, because that's all the cashback is, let's be honest about it. It's just a bribe and some money in their hand. On the other hand, they're doing really stringent affordability. So they're looking for the cleanest of clean first-time buyers. And if I was a first-time buyer right now, I would learn how to make my mortgage application look really squeaky clean. And I think mortgage brokers maybe have some work to do with that, possibly moving forward. But that's another day for another dollar, isn't it? Let's get down to an important topic for you of income tax. Yeah, let's take you through the topic of taxation. Now, I've got a couple of sessions for you on this one, which are going to update you really what's going on. The first one's on legislation and terminology, and then I want to take a look at income tax and how you calculate it without going into some calculations. So the first one I got for you, for your interest and enjoyment, if that's the right way of putting income tax, for your enjoyment. We're talking about taxation, income tax predominantly. And I want to talk about terminology. Terminology. There you go. Terminology. Well, that's a big word for a Monday morning, isn't it? Terminology and legislation and the various things that come through. So first of all, what are the laws which govern income tax? What are the laws really? Well, there's a majority of laws really are combined each year, and I'll explain how it works. Now, 1988 is the last Finance Act, or sort of conglomeration act really, that consolidated all sorts of legislation. But what happens with income tax is you have a lot of case law. Now, case law is where a judge, judges a case, and that case law becomes almost how they operate moving forward. That's known as case law. You also have, of course, the budget, which occurs each year. The budget produces a finance bill, kill the bill kind of thing, which we've been arguing against a previous bill. But bills are to going through Parliament. It then goes through Parliament and it becomes an act. That's why it has to be approved by Parliament. So the budget or the finance bill becomes a finance act, and that gets incorporated into the various acts of Parliament for income tax. So that's just a little bit of background for you. But remember the budget. It does produce the government's thinking about taxation. Now, you've probably heard of the fiscal year. Let's put that one up for you. The fiscal year. For some unknown reason, I think it's to do with the Gregorian calendar or something. The fiscal year is April to April. So it starts on the 6th of April and it finishes on the following 5th of April. So that's the fiscal year. That's when all of your income is drawn up for various sources and then taxed accordingly in the fiscal year. It's not done in the calendar year. So that's fine. That's easy enough. Other terms for you. Here's one for you, residence. Here we are, residence. You've probably come across in your reading. Now, residence means that you have to be a UK resident in order to pay UK tax, which makes sense. We're talking about income tax and capital gains tax predominantly. Now, to be a UK resident for tax purposes, you have to be in this country for at least 6 months or 183 days. So do you remember these terms from school? More, at least that's like the mathematical terminology for 183 days, which in my book is half a year. So that's the main test that they do to make sure you are a UK resident. Now, there is a residential test which they can run if it's doubtful or if you're not quite sure. And this test looks at all sorts of other aspects around your residency. But if you're resident and domiciled, and I'll come on to domicile in a second for you, then you are subject to UK income tax on your worldwide income, plus capital gains tax as well. So that's the whole point. So if you're a UK resident, you're subject to UK income and capital gains tax. But I think you kind of knew that anyway, didn't you? Now, when I say worldwide taxation, worldwide income, it's not actually that simple, because every country in the world pretty much takes tax from their citizens. It's what we do, isn't it? It's what countries do. And if you've got income from somewhere else in the world, but you're based here in the UK as a UK resident, then both countries effectively will want the tax, won't they? Because that's the way it works. They want their tax for the money you're earning there. And because you're a UK resident for tax purposes, we want your tax too. So what happens there is they have this thing called double taxation agreements. Let's just put that out for you. Double or double taxation agreements. Now what happens here, and most countries in the world and the UK have a double tax agreement. And what it pretty much does is it stops you paying tax twice. You know, if you've got income from one country, but you're still a UK resident for tax purposes, and we want the tax from that as well, and that country wants the tax, it stops you from being taxed twice, which makes sense, really. Broadly, they split earned and unearned income. So that's something you need to be aware of. So let's keep the same colour there for you. You've got earned and unearned income. Now, earned income and unearned, you need to know the difference between those two income here. It's got two types there. Pretty much do what they say on the tin, really. Earned income is income that you earn from your graft, if you like, from your industry, from your self-employment, from your employment. You earn the money by physically working effectively, either using your brain or your hands. Unearned income is income you're earning, but you're not actually working for it. So you might have a property which you're renting. You might earn interest from the bank. You might have some sort of dividends from shares. You might have some pension income. This is money that you're bringing in, but you're not actually earning it, if you see where I'm coming from. They split the difference. Now, broadly speaking, what happens here is that if you have a double taxation agreement, then earned income tends to be taken by the country in which you earned it, and unearned income comes to the country in which you're resident. So my dad, for example, he lives in France. If he were a UK resident, I think he's a French resident now, then any earned income would be taxed by the French authorities, and any unearned income, like his pension, would be taxed by the UK authorities. That's broadly how double taxation agreements work. Makes sense, doesn't it? Lovely bit of terminology here for you. Now, the last piece of terminology I want to share with you is the one called domicile. Now, domicile is one that a lot of people get a little bit confused about. Let's just put it up here for you, domicile. Now, first of all, domicile itself really only worries about inheritance tax as far as we're concerned here. So that's the tax we're talking about, inheritance tax. I did mention it earlier that if you are a UK resident and domicile in the UK, you're liable to income tax and capital gains tax across the world. I said that, isn't I? So that comes into it. But for domicile to have its place in the CMAP syllabus, you're looking at inheritance tax. And what happens here is that you have a domicile, usually where you're born, or you take your father's domicile, which is where he was born. So it's your normal place of living. It's not residency for tax purposes. That doesn't come into it. Domicile is something you're given on birth, and it pretty much for most of us stays the same. So I'm a UK domicile. I'm sure you probably are too, although you've probably not thought about it, but you are. And that's the point. You're given a domicile at birth, and that's how you stay. You can change your domicile. You can have what's called a domicile of choice. So you're either in the UK, for most of us, or you can choose your domicile by moving abroad and then severing all links with the UK completely. And there's some actors over in the States that have done that, haven't there? Many English actors out there live and breathe in the States now, and they've severed all ownership of property or any kind of connection with the UK. And that's fine. And you can therefore have a US domicile. But for most people, of course, it is a UK domicile. What they also do is if you died, when inheritance tax, of course, rears its ugly head, if you've lived here for 15 out of the last 20 years, that's changed recently, by the way, 15 out of 20 years, you might have seen it quoted as 17, it used to be 17, but it's now 15 out of 20 years. So in other words, if you've died, and in the previous 20 years, 15 of those you lived in the UK, then you're going to be deemed domicile. That's what happens there, they deem you domicile. Let's sneak that in there for you. They deem you domicile, and therefore you're going to be domiciled in the UK, so your inheritance tax gets slapped. Now what happens with the IHT is if you are a UK domicile, they get you for inheritance tax on your worldwide assets. That's the key one. So if you've got a palace in Bahrain or a mansion in Myanmar, do you like that, do you? Then you will have to pay inheritance tax on those properties as well if you're a UK domicile. So that's the terminology there for you on income tax. I hope you found that of interest. Bye. Do you like that one, did you? All good stuff, eh? All good stuff. That's taxation terminology for you. Let's give that a big old wipe down, and then we'll move on to our next topic. Okay, so that's income tax. And if you're doing your CMAP exams, you probably have quite a lot going on there in the topic for you, particularly CMAP 1. It comes into big time. I want to talk about taxation in a bit more detail now, an area which causes a lot of people a lot of confusion actually. So we're going to take a look at some of that for you as well. Hi, what I want to do now is take a look at income tax part 2, if you like. I want to take a look at an income tax template, which I think's a really good phrase to use, don't you? I would say that, wouldn't I? An income tax template. Because what I'm going to share with you now is how you calculate income tax and clear up a number of, template, a blueprint, a number of misconceptions when it comes to income tax that a lot of CMAP students get confused with. And I've got 5 steps for you for this one. I love a bit of steps, don't you? Step number 1 is you want to calculate all of your income. That's the first thing you're going to do. You work out all your income. So, salary, dividends, profits from self-employment, rents from property, pension income, investment interests from products that you've got invested in the bank. That's all of your income. Doesn't matter from wherever you get it from, self-employment, employment, whatever. It's all potentially taxable, and you've got to add it all up, and that's pretty much an easy thing to do. Now, there is a lot of tax-free income out there, which you need to be aware of. Some of the more popular ones in the exam syllabus are national savings. Some of the national savings interest is tax-free. ISAs are tax-free, aren't they? Lottery winnings are still tax-free. Who does the lottery anymore? Did you do the lottery? I haven't done the lottery for years. Some state benefits are tax-free. Redundancy payments up to a certain limit, they're all tax-free. So you need to be aware of some tax-free income, but the majority of income is then taxable. And that's your income, that's your salary, that's your gross income. Now don't use that figure, that's where a lot of people go wrong. Don't use that figure to work out your tax, because there's 2 things you need to take off first. The first one are your allowances. So number 2 then is less your allowances. Now allowances, let me just put that up for you. You've come across many times before. Allowances are something that everybody in the UK is given, even when you're age 1. We've got a couple of kids next door, age 1 and 3, I think they are. They've got allowances as well, although they probably don't earn money to use it. Everybody has a personal allowance, you see, which you need to check in the tax sheet to see what that is. So, it's over 10 grand a year. It's a lot of money. It's tax-free income. So you deduct your allowance from your income. So the personal allowance is the big one. You've also got what they call the marriage allowance, which allows you to transfer 10% of your personal allowance to your spouse or civil partner. It's a good thing. You have a married couples allowance, which is when you're really old and you can get a little bit of an additional allowance as well because you're like really old. There's no reason, it's just political. There's also blind person's allowance, which gives you just that little bit more money, which is tax-free. You've also got the personal savings allowance as well, haven't you? You know, the £1,000, £500 figure. That's an allowance against your savings income, and you have a dividend allowance as well, which allows you to have some dividends paid without tax. Again, the numbers, check it in the tax sheet. You don't need to remember them because they're all in the tax sheet, but you have to deduct the allowances. That's easy peasy lemon squeezy. Number 3, this is one that not a lot of people are aware of, is you then have to deduct your deductions. This is what we call it, deductions. Now, deductions are just small things, really, which further reduce your income before you start slapping the tax on. Now, the big one is pension contributions to an employer's scheme, where you pay it through your salary. Now, my partner Shelley used to work for a company which she was in a company pension scheme, and she'd have a pension contribution that she paid taken off of her salary, pretty much as a deduction before she was taxed. That's quite a common one, isn't it? Some charitable donations work in the same way. You can also have things that you bought that are wholly and exclusively used for business. Now, I remember a long time ago, I tried to claim a pilot case. Now, when I became a trainer back in the 90s, this is before online, of course, we used to have to go into hotel rooms with all our kit. And I bought a load of these pilot cases because they look really cool. And these pilot cases had all my books and documents and slides and things before we had PowerPoint. And I used to walk around the country with these pilot cases. They were pretty expensive things, 50 quid a pop. So I tried to claim the cost of these from the HMRC. I don't think I was successful because they argued I could use them for other things. I said, well, what can I use a pilot case for outside of work? And we had this toing and froing, and in the end, they grind you down, don't they? So I didn't get any money taken off. So that's deductions. Now, once that's all done, that then equals your taxable income. There we go, taxable income. Now, you've got to be aware of this because that determines the rate of tax that you're going to pay. And people get confused by this. They tell me this, but it's your income, less allowances, less deductions gives you taxable income. And it's at that point, if we go on to step number 4, put it over here for you, is at that point then that you then apply the percentage bands. So here we have the percentage bands of tax. Now again, look at the tax sheet, see what they are. You'll have basic rate tax. You'll have, 25% to get this right. You'll have higher rate tax. There you go. Let's scrub that out. Higher rate tax and additional rate tax. These percentages are based around certain bands. And that's when you start slapping the tax on the income. But you slap it against the taxable income, not your gross income. So that's easy peasy lemon squeeze there, is it? You break it down into slabs. And we've got videos which explain how that works. The last point to make, and I'll put this as number 5 there, is you've got to pay the tax, obviously. And most people who are employed pay under the PAY system, pay as you earn. That broadly means that they have each month their payroll department deducts tax from their income, so they don't have to pay any. And at the end of the year, you get what's called a P60, which is a form which shares how much tax you've paid and what's your income been. Great for mortgage advisors, by the way, P60s and pay slips, because it tells you exactly how much people have earned. If you look at them closely, it's got all this kit in there as well. Some employed people also have to do a self-assessment. There you go, self-assessment. If they have income from other sources, maybe a rental income, or if they're high rate taxpayers, they may have to pay extra tax more than what the PAY is taken out. So self-assessment then is done for them as a means of just adding a bit more tax to their bill. That's employed people. Self-employed, very different altogether. Self-employed people, of course, make profits. Let's just squeeze them in down here. Self-employed. I'm not talking here about directors. of limited companies, they're actually employed people. But a self-employed person, we've got a guy coming in this week to do some work to our bathroom. He runs a trade, he runs his own business, he's self-employed. Now he will do a self-assessment. The self-employed people do self-assessments in the same way as those guys. That's the only way they do their tax. They fill in their self-assessment online form, and then they pay their tax in 2 installments in January and July. They're the 2 dates to remember. They have to pay them in advance now, so that they're paying estimates of next year's bill in January. So they're paying it in advance now, or as close as they can to when they've actually made the money. But broadly speaking, they pay it in 2 installments, half in January and half in July. But in January they have to pay, an extra according to next year's income as well. So they're paying double pretty mumuch all the way through, which is fair enough. And that's how the self-employed pay their tax. Obviously, the revenue has been quite nice to people recently. Self-employed, they let them postpone their July charge, I think, to this January. But they're all catching up with them now, aren't they? PAYE people have had their income tax deducted all the way through. So that's how income tax works. That's the template for you. We've got videos which give you examples of how it works, actual calculations. But I tell you what, here's a little secret for you. Most exam questions in CMAP only really tend to get your understanding of this kit. You don't actually get many calculation questions in the exam, but not a lot of people know that. They get really worried about calculating tax, but there's very few questions, if any, on actually how to calculate it. This understanding is more important, because as a mortgage advisor, you need to know that it's the taxable income that determines the tax rate. It's the tax rate that determines various products you're going to recommend. The old tax tail wagging the investment dog. Hope that's been useful for you. Bye. Hey, we've been giving you some really good stuff, haven't we, on this mortgage live stream for you. Got a lot of people listening to this on podcast now, so that's good news for you. Great to have you on board, Spotify and all those good places. Obviously, YouTube is where a lot of people like to watch the video. And for those of you lucky enough to be on boot camp, we actually have a HD version, in other words, a better looking version put onto the portal. In fact, we've got the summer cohort starting on the 7th of June, if you're interested. We've got a few spaces left, got about 7 or 8 spaces left on that, which is good news. Cohort, by the way, is just a lovely little motivational group of people who I give personal attention to get them through their CMAP exams within a 3 to 4 month period. They all get onto the portal, which has loads and loads of these videos which teach you the topic, because the world has changed now. Us trainers don't have to work for big training companies anymore, in other words, to give you our services. We can go straight to you, in other words, using the internet and using this kit to keep your costs down. Why not? Why pay for the overheads of great big training companies with receptions and Chesterfield sofas and people like that who just run around doing stuff? Now you can have people like me just delivering the training straight to you from the basement of our houses. That's how the internet has disrupted the training sector. And if you're in the training sector, you haven't realized that, well, beware, because it has. People like me can come straight to you. It's like bands nowadays. A good band can get a live stream going and actually promote itself to its fans directly. It doesn't have to have a record label anymore. Obviously, many do, but that's how the world is changing. So if you're interested in CMAP Bootcamp, ping me an email, put a comment on YouTube if that's what you're watching, or just ping me an email at paul@paularcher.com. The YouTube channel is paularcher.tv if you want to watch the videos on there, and then contact me via email or go onto our website and you can get onto the boot camp. It's going to be a good one. It's going to be a good one. Lots of changes coming up in August, by the way, on CMAP, so we can keep you involved in that one as well. Remember, my job is to get as many good people into the mortgage world as possible so that we can bring them into the financial services world too. So it's kind of like payback, really. Anyway, I enjoy this. It's good fun. I love it. It's great. I'm off up for my tea now, or lunch, or wherever you are in the world, depending on your time zone. And we'll see you all next week.